Welcome everyone to our Ask the Experts webinar today. We will begin the webcast in approximately 1 minute. Welcome everyone to our Ask the Experts webinar today. We appreciate each of you joining. We're grateful to be able to spend the next hour with you and want to take this opportunity on Veterans Day to honor our veterans and salute those who are currently defending our freedom. My name is Drew Niehaus, a managing director at Riveron. I'm joined by 3 of my colleagues who are experts in this space and are currently working on a number of IPO and SOX readiness projects. Matt Farrell is a senior manager in our Chicago office. Kavita Agarwal is a director in our Washington, D.C. office, and Ann Heffington is a managing director in our Dallas office. Over the course of the next hour, the 4 of us are going to shed some light on how finance and accounting teams should think about SOX compliance as their organizations are contemplating or have recently executed a capital markets transaction such as an IPO, a de-SPAC merger, or a traditional merger with a public company. With so much effort and time spent focusing on the public offering itself, including meeting potential investment windows, there's often limited opportunity to look toward what lies ahead. And certainly that includes governance and compliance items such as compliance with Section 404. So I'm really looking forward to hearing from each of these experts and their experiences as they highlight for each of you what you can be thinking about as you consider compliance being newly today. During today's webinar, we're going to use 4 poll questions. Each of us to qualify.
Hey everyone, can you guys hear me?
Hi everybody, this is your operator. Please bear with us. We're just experiencing a technical difficulty in the background.
Greg, can you hear me again?
Shortly. There we go. Yes, we can. Thank you, Drew.
Yep, sorry about that. So before we jump into the content today, a few key reminders. On our website, riveron.com, you can access our previous Ask the Experts webinars. There are a number of great accounting and reporting topics hosted there. During the webinar, there's going to be 4 polling questions, each of which must be answered in order to qualify for CPE. So please make sure to enable your pop-ups and we welcome your questions. There's a Q&A option in Zoom that you can use, and please feel free to do that. We'll try to get to your questions, but if we don't, we're going to respond separately. The webinar evaluation form and CPE certificate will be emailed to you in about a week, along with this deck. So you'll have this deck and our contact information. Please note the on-demand video of the webinar will be available on our website. The on-demand version is not eligible for CPE. With that, let's dive right in and hit polling question number 1, which is as follows. How is SOX relevant to your organization? Are you A, a private company preparing for an IPO, B, a public company not yet SOX compliant, C, a public company and SOX compliant, D, a public company remediating a material weakness, or E, not applicable other? We'll give a little bit of time to respond to this one. And as we're waiting, let's get started with a question for you, Matt. What are your thoughts on who truly owns the SOX compliance effort at a company?
Yeah, thanks, Drew. That's a great question. So, I mean, getting a SOX program off the ground is really a multifaceted effort. It requires people from all throughout the organization to kind of tow rope in the same direction. So it really is an all hands on deck kind of initiative, but I think it is paramount to have effective tone at the top and essentially having someone in an executive role kind of championing the importance of this initiative. If it comes across as an important strategic initiative to the executive leadership of the firm, that messaging is going to cascade down to all the other respective players that will contribute to the overall program.
Yep, thanks, Matt. I think that's right. Looks like the results are in, and a number of you are privately a private company prepping for an IPO, which very common these days. So Matt, why don't you continue on and kick us off by setting the stage a bit? What is the timeline for SOX compliance when considering an IPO, and how can folks get a handle on where they sit in this timeline?
Yeah, absolutely. So I just want to take a moment and welcome everyone for joining today. I appreciate everyone's participation. Over the course of this presentation, we plan to cover the relevant areas of the Sarbanes-Oxley Act of 2002. We'll discuss when the various sections become relevant, how to proactively work towards compliance, and then finally, we'll discuss some of the common scenarios companies face on their compliance journey. But before we jump into all of that, I want to start by touching on why is this topic relevant today? As you can see in the attached charts here, there's been a significant uptick in capital market activity over the last 2 years. The sheer volume of companies seeking access to the capital markets has gone, frankly, parabolic during these unprecedented times, and hence that's the focus of our topic at hand today. Needless to say, taking the leap to become an SEC registrant comes with a host of new challenges, not the least of which is ensuring that your internal controls are up to regulatory standards. I don't want to spend too much time here, so we'll jump to the next slide and take a glance at what the typical transformation from private to public organization looks like. So on the slide here, what we see is kind of a boilerplate example of the activities and loose timelines associated with going public. There's always going to be nuance and idiosyncrasies with each respective organization's journey. One thing that I think is consistent for all organizations is that process of going public is one of the most significant challenges the company will ever face. The most successful companies prepare rigorously for life as a public company. And for most companies, this transformation from private to public can span 12 to 24 months. Obviously, there's nuance there. The one thing I would say is it behooves organizations to get started sooner than later. As you can see in the Gantt chart above, corporate governance and compliance efforts should be prioritized concurrent to all else. A good chunk of the activities noted on this slide will be brand new to private organizations. For example, setting up an SEC reporting function. Needless to say, as a private organization, there is no SEC reporting requirement. So it's important to remember that in addition to designing these new functions, a lens to ensure appropriate controls over those new areas need also be applied. As mentioned, an early start and diligent project management will help to eliminate surprises and ensure there's ample time to address the areas of identified deficiency. Like most things, it behooves organizations to begin dedicating time and attention to this matter sooner than later. Procrastination is the enemy of our success. One other thing that I do want to note, this slide kind of lays out the typical timeline as a company takes the leap to public status via IPO. As we saw in the previous slide, there has been a significant volume of the SPAC to de-SPAC route to going public of late as well. I do want to note that SPAC to de-SPAC route is almost like an IPO and shotgun wedding style. It can accelerate the activities noted above, and so it's just important to kind of get your arms around what you have in front of you sooner than later. So before we go into more granularity on SOX readiness, let's first refresh the various sections of the Sarbanes-Oxley Act of 2002 and their respective implications. So on the screen here, you see the various sections that most pertinently come into play as a company is making that leap to public status. Section 302 and 906 go hand in hand, as do 404A and B. Section 302 and 906 basically are, indicate the corporate responsibility for ensuring the accuracy of financial reports. The CEO and CFO are responsible for personally certifying the accuracy of their financial statements, as well as the effectiveness and validity of their overall control environment. So, I think how do we get to that point, right? Important to the 302 process is establishing a sub-certification process. And what that means is effectively setting up channels of communication to inform management on, the doings and current state of their company's financials, as well as the control environment. Setting up a sub-certification process to, kind of pull all the respective individuals. Obviously, this is a more voluminous effort for companies that are more decentralized in nature, that have accounting operations outside of a single corporate function. So oftentimes this is done via some sort of quarterly survey where we kind of pull all of those individuals that have insights into the accounting operations of our business and the control environment, to inform senior leadership and enable them to accurately represent what they're stating here in the financial statements. Want to jump to 404A and B. This is typically the larger lift and the area that presents the most residual effort for companies as they're making that leap from private to public. 404A is effectively management's assessment of internal controls, and effectively the to-do there is beyond assessing the design of the control environment, but also implementing a operating effectiveness compliance program to, first, test the design and ensure that we have appropriate controls designed to mitigate our underlying risks, but then to go in and statistically sample and test the operating effectiveness of those controls in practice. 404A, as we'll kind of get into on the coming slides, comes into play in year one. 404B is the independent auditor attestation around the validity of the control environment. Effectively, that's when the external auditors come in and independently perform their own operating effectiveness testing, as well as design effectiveness testing, and opine on the validity of the control environment in an independent capacity. So now that we've kind of familiarized ourselves with the relevant sections of the Sarbanes-Oxley Act of 2002, let's jump into what the typical SOX readiness timeline looks like. So what you see on the screen here is kind of our typical SOX readiness timeline, inclusive of some of the key activities and when they come into play. The key takeaway here, as mentioned previously, is that the pre-public activities can start as soon as the organization is ready, and it's often prudent to do so sooner than later. I'd like to home in on the first bullet in the pre-IPO bucket here. Proactively assessing the effectiveness of your organization's control environment, even before going public becomes imminent, can help clear away unknowns on the path to compliance by identifying where the company faces risks and moreover, unmitigated risks. After doing so, an organization can put in place tangible action plans to remediate the identified areas of unmitigated risk. With the rush to the capital markets that we've seen of late, proactive can and has been often sacrificed for hastiness. As a result, many companies going public face deficiencies in their initial Form S-1. I do think it's important to note, year one deficiencies aren't the end of the world. Many investors have developed a sense of forgiveness for these year one deficiencies. It's really when control deficiencies remain in year one that investors often can become leery. So I think it's important to first get your arms around the design of your control environment sooner than later. Understand what those residual efforts are that we need to kind of put in place to get to where we would want to be. And again, a year one deficiency, they happen. Obviously, a lot of accountants are control freaks and want to, get a clean slate. So absolutely encourage that the pursuit of that. But more paramount, I would argue, is when you do land a deficiency early on, that you put in place a proactive and diligent approach to kind of setting out a plan to remediate them accordingly. Okay, so to summarize, the sooner your organization can deploy an effort to document their control environment, gain an understanding of where it faces these unmitigated risks, the more runway you'll have to ensure that deficiencies have been addressed, potentially even before filing the Form S1, but certainly before the year 2 10K filing. So I'd like to now jump to, kind of a couple of the categorizations of SEC filers. As well as the implications that each categorization has. So the first one I want to talk about here is emerging growth companies. Emerging growth companies are a designation that gives a little bit of extended runway in establishing the 404B program. 404B, if we recall from the previous slide, is the independent auditor attestation to the control environment. As an emerging growth company, let's just kind of start with understanding what classifies an organization as such. Emerging growth companies are companies that have annual gross revenues of less than $1 billion or has not issued non-convertible debt in excess of $1 billion. I'd like to comment that those numbers are not hard figures. They have been adjusted upwards for inflation and will likely continue to do so. So it's important to kind of keep your eye on what the current guidance is when assessing what category you fall into. The next two here are pretty similar in terms of the implications. Large accelerated filers and accelerated filers. Accelerated filers are effectively organizations that have a market cap or public float in excess of $250 million, but less than $700 million. $700 million is the threshold for being classified as a large accelerated filer. Really, the key implications here between those two categorizations primarily lands with the duration the filer has to issue their 10K. For accelerated filers, they get an additional 15 days to file the 10K at year end than would a large accelerated filer. So again, just wanted to kind of cover some of these kind of categorizations because they do have implications on when the various sections, namely 404B, would come into play, and also on kind of the reporting deadlines that each company will face as they take that leap. Okay, looks like we have a polling question here coming up next.
Yep, thanks, Matt. So let's move on to the second polling question. So what is your experience working in a SOX compliant environment? A, 0 to 1 years, B, 2 to 4 years, or C, 5+ years? While we're waiting, Kavita, how should a company approach assessing their current control environment when there's processes that are undergoing significant changes like system implementations?
That's a great question, Drew. To answer that simply, I would say if we're talking about a new system implementation, say a company is wanting to replace an existing HR system with a new system like Workday, it's best to review the current state of risk and controls and then evaluate what changes need to be made to the existing controls landscape for that new system. It's important to look at the changes and gaps and then create controls to address any unmitigated risks. Some other things to keep in mind is that the company would want to determine what information is to be transferred or converted to the new system, establish an approach or strategy for the conversion of the data, and ensure that the right resources are in place to be able to have a successful implementation. So Now that we've level setted with what's needed in order to be SOX compliant, Matt gave us a lot of great information on that. We'll move to our next section, addressing areas of known deficiency.
Yeah, hey, Kavita. Yeah, no, that makes sense. Just really quick, I thought your answer was comprehensive and perfect on that question. I think one other thing I want to highlight there is that, to the extent that you are, I think a couple years out from an IPO and you're really thinking proactively about this, I think it's a good idea to potentially, press pause on some of those walkthrough discussions potentially, and design evaluations if you're going through an ERP implementation or something significant like that. There's cost considerations as well to doing that multiple times. So just wanted to add that as well.
Yeah, no, that's perfect. That's exactly right. Thanks for adding that color there.
Yep, and Matt, I think kicking it back to you for a second, if we could we just talk about how at a high level a company should approach getting SOX ready?
Yeah, absolutely. So, I mean, we covered kind of the timetables, but let's get into some of the granularity of how to execute on this. It's often an analysis paralysis of where to begin with some of these big programmatic rollouts. So let's look at kind of a 5-phase approach to SOX readiness. It really kind of starts at the top with a top-down risk assessment, understanding where our organization faces risks, and then is the obvious starting point before we would look to start designing controls to mitigate those underlying risks. So how do we do that? I think it's important to first apply a quantitative lens and understanding materiality. We're inevitably going to have auditor validation of our approach and our control environment writ large. So it's kind of important to put yourselves in the shoes of the auditor and think like they do. Needless to say, anyone who's dealt with an audit has heard the word materiality countless times. And I think it's important to first kind of establish a materiality threshold against which we would bump up our financial statement line items and understanding what is going to be material from a quantitative perspective. And then also, layering in the qualitative factors as well. Things like, the degree to which transactions are processed manually, the volume of transactions, the degree to which, there's potential fraud risk in play, are just a couple of the qualitative factors that we would want to layer in kind of aggregating that risk assessment. From there, based on the risk assessment that we've kind of compiled, that's going to serve as an indicator of where we need to scope our program and where we would want to go through what we would call kind of current state understanding, working through at a very detailed process level to document the business processes that feed our key business cycles, and furthermore documenting the underlying controls that we have in place to mitigate those risks identified in phase one. Needless to say, as you go through that effort, there's always, not always, but almost always going to be some areas of residual risk exposure. And so in those circumstances, I think it's important to kind of drive a remediation program to kind of address those areas of identified deficiency. As we kind of touched on earlier with 404A, it's also paramount for management to develop and implement a control testing program, ultimately to validate that, hey, we got comfort with the design of our control environment, but are we doing what we say we're doing? Kind of getting in the weeds and testing transactionally at a statistical sample level that the controls are operating as designed. And then finally, phase 5 here relates to the reporting component of Sarbanes-Oxley. This really kind of ties back in section 302 and section 906, where it puts the onus on the chief executive officer and chief financial officer to personally sign off on the effectiveness or the lack thereof of controls in certain areas around their control environment. So I think I wanted to cover the kind of the phased approach to SOX readiness But I think we also want to get into a little bit more detail on some of the common stumbling blocks that organizations face in this journey. So with that, I'd love to pass the baton over to Kavita to kind of cover some of the common scenarios that can increase the likelihood of a significant deficiency or material weakness.
Hey, thanks, Matt. Appreciate that. Thanks for level setting us there on the 5 phases. So yeah, as I was getting into, addressing areas of known deficiency is definitely an art and it's not a science. Actively working through remediation steps along with having other strategic initiatives in mind can certainly help prevent issues in execution. It's really important to be mindful when it comes to prioritization, timelines, and just generally alignment with company goals. So what are the common scenarios that increase likelihood of a significant deficiency or a material weakness? Well, based on our experience and research, we've highlighted 6 areas that we feel are common scenarios. Please note that there could be others, but these are the ones that we've captured for our discussion today. So I'll go over each of the scenarios with some practical examples, and I'll provide some preventative measures to consider. So we'll go right into it. So the 6 common types of scenarios are: first, technology implementation and ITGCs. Second, we've got business combinations, divestitures, other significant transactions. Third, qualifications, turnover of key company personnel. Fourth, complex accounting topics and emerging issues. The 5th one is inadequate segregation of duties or monitoring controls. And lastly, failure to address completeness and accuracy. So let's talk about the first scenario, which is technology implementations and ITGC. Here we see a real life example in which a luxury shoe designer and seller disclosed in its 10K that they did not design and maintain adequate ITGCs, which resulted in material weakness. So here I show you a real example. This is coming directly from their filing. So, it is a little text heavy, but I'm not going to read the whole thing to you. We'll just go over the bullets above. Okay. So some of the ways to prevent the findings is to implement change management controls, which will minimize disruptions, alterations, and errors to the IT environment, periodically rationalizing access privileges for all system users, ensuring data integrity prior to data migration. So that one's really important. Identifying all key reports generated out of a new system and ensuring effective completeness and accuracy. Finally, ensuring controls are designed to address the relevant risks. Okay, so the next scenario is business combinations, divestitures, and other significant transactions. That's a big bucket, but let's break it down here. For this example, we've got a mid-sized aerospace and defense government contractor. They disclosed in their 10K that there was an issue with how they handled components of a refinancing transaction. So some steps to prevent such finding could be to engage third-party specialists who can help provide guidance on these complex transactions. You could hire technically savvy internal staff to assist in the significant transaction, or consult with internal and external legal counsel to ensure all contractual terms are understood and disclosed appropriately. That's something that they should have considered in this example. Some other points to consider when faced with findings related to business combinations or divestitures would be to ensure that the efforts include focusing on standardizing controls across newly acquired business units. And lastly, to really ensure that your risk assessments are all refreshed to incorporate the impact of the business transaction, especially on that enterprise risk management program. Okay, so the next scenario, it's a third scenario here, it's qualifications and or turnover of accounting finance personnel. And I know we've all seen that happen. So in this case, we've got a hydrogen fuel cell company that reported in their 10K that they had a material weakness because they did not have sufficient well-trained team or staff in respect to their oversight responsibilities for ICFR. So they were unable to, conduct their risk assessments as well as, design appropriate controls related to the overall company risk structure. So in this case, a recommendation really would be to go out there and hire the appropriate resources in order to meet company objectives and really to be in compliance with SOX. Some other points to consider if you're faced with this scenario is to ensure that control ownership is transferred to the appropriate employee when that particular person leaves, right? And then you also want to make sure that you transfer the knowledge, right? Especially when there's a lot of turnover happening or changes within the organization. And finally, this is something that I find to be really important is that we don't have key person dependencies. We really should take the effort to cross-train employees on important tasks, projects, and deliverables. Okay, the fourth scenario is complex accounting topics and emerging issues. Now, for this example, we've got a digital sports company, right? It's an entertainment company. And this particular company had a material weakness as well, specifically in their classification and accounting for assumed warrants. So this has been a common issue in many of the SPAC transactions that mainly due to the new guidance that was issued by the SEC this year. So we're seeing more of this happen. In this case, to remediate this weakness, the accounting had to be corrected, financial statements had to be corrected as well, including the related disclosures. Now, other points to consider here would be to update necessary accounting policies to be aligned with new and emerging standards and topics. Companies should also work closely with their auditors and consultants to ensure proper accounting for complex topics and significant transactions make sense, right? That they're appropriately updated. And lastly, hire qualified staff to appropriately provide that technical expertise when future transactions occur, because we know it's not a one-time thing, right? It's better to be fully staffed with the right people to handle those situations. And the fifth area, as we move along here, is inadequate segregation of duties or monitoring controls. Now, for this example, we have another company here. It's a rental vehicle provider, and they also reported a material weakness. This one's specific to segregation of duties. So for this, points to consider for remediation would be to review your headcount constraints, right, which would give rise to ineffectively segregated critical responsibilities, right, such as an individual, who initiates a purchase order, but they're also approving their own purchase order. Yeah, that would not be good. Not be good. Implement compensating and mitigating controls such as supervisory reviews, performing monthly reconciliations, maintaining audit trails and transaction logs. These are all great ways to have compensating and mitigating controls in place, right? And lastly, having that oversight, right? The management oversight review controls. That's going to really help to really instill that effective monitoring that we need, right? And the precision of control related to management review is definitely going to be a higher level of precision, but definitely something that's super important at the very end of it. And finally, I know we've talked a lot about all these different scenarios, but the last scenario we've got here is the failure to address completeness and accuracy. So in this case, we've got a SaaS company who hosts applications for cloud-based collaborative project management, right? So it's an interesting company. And in this case, another material weakness was reported in their 10K. And this was specifically around completeness and accuracy in their order entry and pricing processes. Ultimately, it impacted their financial statements. So that was not good. So points to consider here when we're faced with this type of scenario would be really to understand and really inventory, categorize the information produced by the entity, which is known as IPE. I'm sure you all have heard of that, right? Includes source data, report logic, report parameters. We really have to know that information. The next point to consider or to remember is really we want to make sure that we're validating the completeness and accuracy of the information that's used in the control, or IUC, specifically by tying back to independent data sources. And finally, document supervisory review and the approval of manual procedures, such as reviewing formulas in a spreadsheet and reperforming complex transactions or calculations. When we know all about spreadsheet controls, right? So really having good spreadsheet controls if we're not using another sort of kind of system in place. So if we don't have anything automated and we're using a manual process, really make sure that we have good spreadsheet controls in place, right? So those are, in summary, we just went over 6 common scenarios. I'm sure there are others, but these are the 6 main ones. They're causing material weaknesses and significant deficiencies, and you can see it in those real life examples, right? If you have specific questions related to your company that you want to run by us, feel free to reach out, and we'd love to help you. So that wraps up this section, and now I'll kick it back to Drew for another polling question.
Yes, thanks, Kavita. Let's move on to polling question number 3. How confident are you that your organization effectively assesses and mitigates access risk? Very confident, B, not very confident, C, unsure, or D, everyone has access to everything. While we're waiting, Anne, we focused a lot on financial accounting issues that cause significant deficiencies or material weaknesses. Have you seen similar issues with tax?
Absolutely. Thanks, Drew. With the rush that Matt referred to and companies trying to hit the market while it's hot, people have gone public before they've been able to get everything up to speed on the tax side as well. Assessing what their controls are, documenting what their processes are. And so there are often some issues in that first round of financial statements.
Yep, that makes a lot of sense. And it looks like, the results are in, and it's a little bit of a mix in terms of access risk here, although it's nice to see that about 40% of you are very confident. So Anne, let's stick with tax here. In the past 24 months, as you mentioned, we've seen tax as a common problem area, in terms of controls for companies looking to go public. So let's dive a little more deeply into this area for those in the audience who maybe aren't tax experts. Maybe discuss some of the root causes and what they should be doing proactively, potentially.
Sure. Let's jump into tax. All right, this first slide is really just an overview of restatements. So material weaknesses and SDs can lead to restatements. This is just to help those on the phone understand the issues identified, and tax is on the slide. It's one of the issues that commonly occurs in restatements. So let's jump into the triggers or red flags, the common challenges that clients have related to tax and getting things right. I have been on the other side as a VP of tax, and there is lack of internal communication. There are companies, most of them that I worked in, where there are silos, and tax doesn't always know what's happening, if there are new lines of business, or exactly what it is that the company is doing that needs to be reflected in the tax provision. So client challenges with communication is common. There is a compressed timeline. A lot of times the tax provision has sometimes as little as 3 days, 5, 7, 10 days to get the tax provision done. If there are some delays in the handoff to tax with the pre-tax book income, it can cause the timeline and the review piece of presenting a complete tax provision, and that can cause issues. Reliance on manual systems. as Kavita mentioned, there are, there's a lot of reliance on Excel, and there is the tendency to have human error, of course, in that. So having the spreadsheet checks within it, checks and balances, does this, pop up as a red if it's not working? Is it, so reliance on manual systems can create challenges. And then fourthly, lack of internal resources. As most of you know, there is the great resignation in 2021, and that applies to the financial side as well as the tax side at our clients. Losing those with the historical knowledge of the company or the knowledge in ASC 740 tax provisioning can create challenges to create a good tax provision that stands up to the audit challenge. So let's look at how we can prevent or remediate any problems in tax. As I talked about the lack of communication or silos, in the companies I led the tax function for, I scheduled a pre-close meeting with key business persons within the company. So accounting, treasury, legal, and your international team members. If you have non-US operations, you need to stay in communication with those on the financial side in the other countries, learn what they're doing, make sure you're in the know. Discuss unusual transactions. So you want to talk about those. I think Kavita talked about those as well. So on the M&A side, or if a debt restructuring happens, discuss those, get in front of those, even reach out to your auditors to talk about the impacts that you anticipate in the tax provision from those unusual transactions. In these meetings, you can identify new general ledger accounts, new lines of revenue, new lines of business. These things all can impact your tax provision. So discussing those pre-tax timeline for the close can be helpful. And then agree to your timeline. Agree to when tax will be on the clock, and agree to when tax will provide the entries. And it's always good to put stakes in the ground. Now those may have to adjust and move, but you need set timelines going into this close window. The second item, the item to the right, is accelerate work. So I keep talking about the close timeline in this window that tax has to get a tax provision and get tax entries booked. There are things that can be done prior to tax being on the clock. You can calculate depreciation and amortization. You know what assets you've had. You can get your assets that have been added. You can look at that outside of this closed window, and that can be a huge effort. There's a company that we were working with earlier this year that one person spent an entire month working on it. I'm like, how is that possible? Well, it is possible. So pull that out of your timeline. Look at any gain loss on disposals. There can be, large segments of businesses that are sold during the year. How is that going to impact you? You can talk through that with your auditors ahead of time, nail down the impacts of that before you're in your 5, 7, 10-day timeline. And then there, depending on materiality, I think Matt referred to materiality earlier, you can use actuals plus 1 month of forecast for some book tax differences. Not all book tax differences are going to be material. So you can use forecast for that last month on some of these and pull that out of your window. The third point, maintain tax account reconciliation. So this sounds so easy, and it's like, Ann, why would you even mention this? But as you'll see on the next slide, I have a reason. You want to prove out what your tax payable and tax receivable balances are. This means more than just taking, if it were $10 at the end of last month and you paid $2 and you accrued $3, the ending balance is $11. No, that you need to prove out exactly by jurisdiction what those balances are. It'll help you, it'll give management the comfort they need to sign off. And you as the financial person, you're going to feel good with what's in your accounts. Assign appropriate resources. As I talked earlier about the Great Resignation, you need to look at, okay, how are we going to do this? Do we have the internal staff with the right knowledge to get this done accurately and timely? Do we need external review? We may not need external help preparing, but we may want a second set of eyes outside of the company to review it. So let's move on to some real life examples. I have barely lived through a material weakness in tax for a SaaS company who was unable to prove out their payable balance. I mean, again, it sounds easy. Even my kids were like, Mom, does the payable foot? I mean, it was something I came home every day saying, we can't figure out this $20 million number. So not rolling your accounts, but proving out your income taxes payable is a big thing to do. A significant deficiency in tax for a retail company because they did not account for a one-time item appropriately. That it happened during the quarter. They left it in their AETR, or so their annualized effective tax rate, but it was also included as a discrete item or a one-time item. So it was effectively double counted. Getting ahead of those one-time items, talking with your auditor about the treatment of those can really help prevent an SD in tax. The other item is foreign tax provisions based on IFRS. So that's unusual. That's something you need to be in communication with your foreign colleagues on this to make sure you're accounting for things in US GAAP. The recent material weaknesses in tax that I saw from Edgar listed inadequate internal controls. So Kavita covered this as well, but you've got to have the process in place, the reviews, the checks and balances in place. Measurement of your valuation allowance. So with the last couple of years, what we've been living through with COVID, some businesses have really suffered and needed to look at their valuation allowance. Is there realizability on those assets they have, a net operating loss, a tax credit? So that's something you really need to look at, and you can look at that before year end. You don't have to wait till the crunch in February or whatever your timeline is to look at that. And then to remediate, a company listed that they needed to increase their review of the tax calculations, including the use of external experts. So think about it now. How are you going to get the review done and make sure you've increased your efforts around that? So Drew, I think it's time for another polling question.
All right, thanks, Anne. Yes, polling question number 4. Which of the following processes represents the highest risk at your organization? A, new technology implementation. B, business combinations or divestitures. C, turnover of accounting personnel. D, adoption of new accounting standards. Or E, completeness and accuracy. And while we're waiting, a number of questions have come in, and we wanted to touch on as many as we can. So maybe we'll take this time to address one of them that kind of ties into this question a little bit, actually. So it reads, can you discuss what I should be thinking about as a public company acquiring another company in the coming months? Matt, any thoughts on this one?
Yeah, great question. If we kind of circle back to, the approach to SOX readiness that we kind of covered on the first couple slides, it's really pretty similar, right? As a public company, you're already going to have an annual risk assessment process in place, or if not, you'll have material weaknesses. So really, it's a matter of refreshing that risk assessment to understand the implications of, incorporating that new business acquisition into your broader assessment of scoping assessment, right? So effectively kind of getting consolidated financials and then breaking it out by the various legal entities or business units or segments, however the company ends up segmenting, and then drilling down and kind of applying that lens of materiality to, that segmented level. Ultimately, it's really going to be at that consolidated level, understanding what's going to be materially in scope, but then drilling down from there to understand where are the key components of each of those respective balances. If 90% of the AP activity sits on one legal entity, then in all likelihood we'll have effective coverage of that broader consolidated FSLI. And by just looking at that entity, and we can kind of save some of the efforts around the compliance program. I do want to highlight quickly, it's not to say that controls around the less material legal entities are not of importance. It's just less of a factor in terms of the compliance program. I'd always encourage, regardless of materiality, to kind of instill the proper level of controls across our organization.
Yes, thank you, Matt. It looks like the results of the poll are in. Pretty even split here. Technology implementation coming out front, which makes a lot of sense, especially considering a pre-IPO environment. A lot of companies switching to a new ERP that offers kind of greater capabilities, and completeness and accuracy coming in second here, which always a hot topic, especially with our auditor friends. I did want to touch on a couple other questions that came in since we have a minute here. One was, how do we think about cyber risk in an IPO process? I think at a high level, companies should look to accomplish a few things in a pre-IPO setting related to cybersecurity. Again, another hot topic. I think addressing the data compliance obligations specific to your company is the very first step. The second thing is inventorying out, again, specifically to your organization. What are the assets, the software, and the data that represent potential vulnerabilities if they're exposed? And then three, formalizing, spending some time to formalize an IT security process for things like ensuring there's an incident reporting structure in place, if those assets are exposed. And then what is the process to respond to cybersecurity incident when it does occur? Again, very high level, that can be tailored to each company specifically, but I think those are the three main bullets. One other question is, let's see, how can we address internal controls for remotely located employees? Matt, any thoughts there?
Yeah, absolutely, Drew. I think it actually ties in hand with the cybersecurity risks that you just covered there as well. I think, in a pre-pandemic world, I think we'd taken efforts to ensure that we have effective security around our company's networks and things of that nature. But with the shift to remote working arrangements, needless to say, a lot of the company's business activities are transpiring now on people's home networks. I know I'm sitting in my home office right now, and I think there's an extra level of scrutiny that needs to be applied with this shift to remote working, kind of factoring in that understanding, right? I think the use of virtual private networks can help to address some of those concerns, but I think with this shift, and there's just an increase in all types of cyber attacks. The traditional ones you're aware of, the phishing schemes, but then also kind of the behind the scenes ones that are less evident in practice. So I think it's paramount to kind of reassess the landscape that your systems and networks operate on, especially considering the shift to remote working arrangements.
Perfect. Thank you, Matt. So in closing, I just want to highlight for everybody some of our recent thought leadership on topics discussed today, so you can use them for reference. Certainly a number of relevant publications on here to our presentation today covering SOX and public company readiness. We really appreciate everyone joining. We look forward to meeting with everyone again in future webinars. Enjoy the rest of your day, everyone.